A very warm welcome from my end to our Deal Talk edition today. It's actually the 12th time that we are running this format, so delighted to be here with you. This time I have the great pleasure of introducing one of the leading forces behind CVC, a firm that is practically a household name in private markets. Søren Vestergaard-Poulsen is a managing partner who joined CVC some 25 years ago at the early stage of the industry in 1998. He is co-chair of CVC's private equity board and oversees private equity activities in the Nordic region. Søren also helps manage a firm with, in the meantime, 25 local offices and some 156 billion of assets under management. Søren, thank you so much for joining us today.
Thank you very much, Steffen, for having me.
Before I dive into our questions, Søren, I want to remind the audience, at the end of the session we will run, as always, a Q&A, and it would be great if you hand in your questions while we are talking, everything that jumps up to your mind, and then we will call them out and reserve some time at the end of the session to go into them. But with that, let me start, Søren, with one of my questions. You might have heard, unique in the history of Germany. Germany just won the basketball championship. Amazing, everybody is now in basketball. And I read somewhere that you have been a handball coach back in the days, which is not a surprise to me, given how popular it is in your home country in Denmark. What would you say that the financial world can learn from sports?
That's a long time ago, Steffen. I think listen, handball or team handball, as it's called in the UK, think of it as rugby played on a basketball court with football goals. It's a contact sport, it's a gentleman's sport, and I was not only a coach, I was also a decent player and captain of my team. I think what I took with me from handball is that in a team sport, you play a full match. In the beginning of a match, it's about the entire team playing well. And in the end of a match, sometimes someone needs to take the responsibility to decide the outcome of a game. And that is sometimes the best player, and is sometimes the captain of the team. And it's a little bit the same in investing and in the finance, that you need to work as a team, but sometimes there will need to be a leader that steps up and put it into the goal at the end. And so I think there's a lot of things, the coaching, understanding different roles and positions, and how you get the best out of a group of people rather than just a group of individuals.
Look, Søren, CVC became if I take the past 20 years, an iconic name in the industry. And you are clearly, if I may use the word of sports, you are clearly playing in the Champions League in private equity. And sports in general is also a very, very important investment theme for CVC. Your firm is one of the largest, biggest investors in elite sports. In general, you have stakes in the Spanish football liga, you are in the Women's Tennis Association, rugby, volleyball, and then, of course, maybe most well known for your famous investment into the Formula One, which turned out, I believe, to be one of the most successful investments in the firm's history. What is that you see as a special attraction in sports, and is investing in sports different from, call it, investing in more traditional buyout industries?
So our view is that sports is like investing in any other industry. And a lot of similarities. It's about building better businesses. It's about building better business for all the stakeholders, but in particular in sports, it's about the fans. So getting a better product, getting a better way to deliver the product to the fans, so it becomes a great experience. Because if you manage to do that, you get a great outcome of your investment. What is a little bit different is in a normal business, you compound the business and growing the business year after year after year, whereas in many sports businesses, it's more of a 4-year cycle. So you renegotiate your media contracts every 4th year, and then you have a jump in your sales and hopefully also in your profit, but you will have a little bit of a flat period and then a jump and then a flat period and then a jump. So that's the difference. So if you miss a window where you're supposed to get a jump for factors that are outside your control, then it's of course a more risky investment. But fundamentally, if you improve the product and the value of the content, and because this is a scarce value, it is a very attractive segment to invest into. But it's not without risk. And you need to be... We have a dedicated team, and they're very, very good and very dedicated for looking for new opportunities and managing portfolio and driving the value into our sports assets.
Look, you said it. It's all about creating value, and you know that I've been for over a decade with KKR, and one quote that Henry kept on saying, which I very much like, he said, every fool can make a deal. It's all about, that you pay enough. And the real work starts once you have done the deal. CVC did a very successful deal in the luxury watchmaker Breitling in 2017 and realized a remarkable markup in value. And then in a recent deal with Partners Group, you materialized some of this value through a partial exit. Can you elaborate a little bit how you did this when it comes to value creation at Breitling?
Yeah, so Breitling is as we all know, it's a fantastic brand. It has a great heritage. We found that it was potentially a hidden jewel that we could polish up to something even more by focusing on the heritage, focusing on the historical product catalog of fantastic watches. So that's what we started out with. We then worked a bit on the sales channel, and they had outsourced a lot to distributors. We decided the German team decided to focus on that and do much more direct to consumer. We got a fantastic, real rock star of a CEO into the business, and we were basically backing his vision to take it forward, and he was leading it and driving it, and he is the type of managers we love, who is living his business day in and day out, and living and breathing the business, and we were super successful in backing him and backing the initiatives he launched, and to drive it forward. And we took it to new product segments, new customer segments. So it started out being very much about aviation. We broadened it out and became much more about also surfing and other sports features, and also targeting women, launching a complete new range for women. So it is really a story of success where all things came together in a very nice way, and we had a really, really fantastic. It went up the ranks among the top watches in the world, and I think is today among the top 5 in the world.
Thanks, Søren, for this background. Look, as I call them, the honeymoon years, which started probably a few years after the financial crisis, are probably over, and circumstances have changed dramatically over the past 18 months. Let me ask you, how has CVC and you have adjusted to this shift in the macro environment?
So, as you said at the beginning, Steffen, I've been with CVC for 25 years, and we have seen a lot of different crises. We have had, well, just to mention a few, like the dot-com crisis, we had the great financial crisis, we had the Ukraine crisis, we have energy crisis, we have FX crisis, interest rate crisis, I just to name a few. So it is part of being a professional investor. You need to be able to cope with these type of dislocations that's going on in the market. And the way we are thinking about it is that we are trying to find investments that are very robust in its nature, operating in good sectors where we have a clear value creation program so we can see how do we make this a better business. If we're able to make it a better business, we will more than likely also make it a good investment. And we always protect our investments a lot by say we don't sit with open interest rates risk. We're boxing it in. We're trying to look at what are the FX, if they're commodity risk, or whatever it may be. We're trying to understand and trying to eliminate that risk or understand the risk and box in the risk. And all these macro crises, it's about the same thing. Our portfolio is more than often, and most of the portfolio will be in good shape. It's not always the case because there can be, all the crises are a little bit different, they have different features. But most of the time, I would say, large majority of our portfolio will be able to manage through such a crisis without any risk, without feeling the risk. And at the same time, it's an opportunity as an investor to find new deals. And it's very easily set, but very, very hard to execute. But to find those new investment opportunities in a market that's a bit in a flux, where the banks may not be playing along and you need to over-equitize a bit, often in those situations, we are able to make very, very, very good investments.
Look, it's interesting what you say. A very senior guy in the private equity industry recently told me, look, I've been working with some of my investment directors over the past 10 years, but I still can't tell you whether they are really good investors because everything was going up. And we at Moonfare, we are big believers, in manager selection. And manager selection counts now more than ever. And this is why we take a particular look exactly in what you have just said. We like managers really who have tools and call it a plan, what to do with companies in a downturn, who have experienced the grand financial crisis, 9/11 and other times, and your career goes back 25 years. That's clearly helpful. Look, in our related to this, in our last deal talk, we had Henry Kravers here with us, and I asked him, what do you do in terms of how you approach investing in a recession? And interestingly, it sounds obvious, but it's quite interesting. He said, look, we focus on what we control. Look, you are very seasoned and a very seasoned investor yourself, who has seen all these economic highs and lows. What have you learned about investing in downturns specifically?
So it is very difficult to invest during a downturn, and I think we as a house, we are very cautious, and we become extremely selective in a downturn in what we are pursuing. And when we started with, one of the more recent downturns, like the pandemic, when it broke out in 2020, we didn't know what was hitting us. So and we were in the middle of fundraising, by the way, at the same time. So we basically started focusing on the portfolio. Let's protect the portfolio. When we had done that, so deep, there was cost, capital, efficiency, protecting that portfolio. When we were 6 to 9 months in, we felt, okay, that is actually looking much better than we expected. Let's now look outside to see what are the situations we can pursue. For the portfolio, we did a lot of add-ons that can be highly accretive for the portfolio and the value creation for the existing investments. We were then very selective about new investments, and we were very thoughtful about structuring and managing the risk reward in those investments. And I think some of them will turn out to be very good investments. And the interesting part is when you are an investor, and you will know this, when you're doing due diligence on a business, you're doing whatever you can to understand the business. But the reality is you only really know the business 6 to 9 months after you've closed the deal. So that's when you know what you have on your hands and what you can work with. So for young investors, when they come marching in, they're say high opinions of themselves, if you want, then they need to be trained, and they need to be trained by senior people around them. They think they know everything and they know the world and they can win the world. But the reality is that they need 4 to 5 years of training before they should be let loose to look for their own investments. They need to be coached, they need to be monitored, they need to be mentored, and that is the way we are thinking about it. Then when we do these new investments, it's all about the risk reward. How can we minimize the risk and maximize the reward? And we do that over the life of the investment, and we do that by, say, controlling the value creation program and trying to understand the factors outside our control. What are the black swans that could fly by and cause a lot of havoc? Because you can't influence it, but you can try to think about how to protect yourself for those situations.
Yeah, look, it's interesting what you're saying. So, we at Moonfare, we are extremely data-driven, and we have a large content and research team, and all empirical data speak the language that private equity in a downturn, in a recession times, even outperforms more public markets than, call it, in the good times. And that, interestingly, Blackstone took advantage of it post-global financial crisis. They went long. Apollo did the same. KKR, did the same post-COVID. They were the most active investor globally post-COVID. And it's an interesting pattern. But of course, as you say, it's a difficult environment. It's far more difficult to invest in. Look, we are seeing, and it's talk in town, private markets seem to have slowed down quite substantially. Some of the people I'm talking to, we are talking to in GP landscape, private equity world, are saying this is the worst fundraising year since I'm in private equity, or even worse than post-financial crisis. A deeper look into the data, by the way, shapes a slightly more complex picture, because the first half actually of 2023 was not such a bad fundraising year. And this was in particular and very much driven by the tremendous success of your fundraising. I think you raised the largest buyout fund ever, as far as I know, with 26 billion in assets in such an environment. Look, you will tell us performance and so on, but why, can you shed some light why in these days the fundraising, the CVC fundraising has been so successful? By the way, we have been part of it, so very glad to be part of the CVC family now as an investor. But what made it such an incredible successful fundraising?
So first of all, we're very happy to have you on board as an investor in the fund. I think this may sound very simple, but it comes down to our relationship. Of course, the performance is super important, but then secondly also because first and foremost it's about performance, having consistency and robustness in your performance, and then it's about keeping your word, stick to what you promise, deliver what you say, and not drifting in your investment style or investment strategy. And we have been fairly good at sticking to what we tell people what we're going to do, and that's what we do. As simple as that. And then it's about the trust. For us, it's a huge privilege and an honor to be looking after our investors' money. It's a lot of capital. It's a lot of people who are relying upon getting this capital back with interest, and we take that very serious. And we are very concerned. We're like basically a bunch of concerned investors that are trying to foresee what can go wrong and trying to protect the capital we have been trusted in the best possible way. And then we're keeping all our investors constantly updated about what's going on and how we are thinking, and they can all reach out to us at any point in time, and we will pick up and explain to them exactly what's going on. So it's very much about that. It's and then it's about delivering the returns, and how are we delivering the returns is also quite important. And we hired one of the top consulting firms in the world, asked them to do an analysis of how our private equity firms generating the returns. And they turned out that CVC is delivering twice the amount, 60% of the returns we're generating is by improving the EBITDA margin. So building better businesses. whereas the market it's only 30%, and 70% is really from multiple expansion. We are not relying upon multiple expansion. We don't get as much multiple expansion because our business mix is we don't have as much technology, and over the last 5 to 7 years, all of that multiple expansion has come from technology companies. And a few years ago, our LPs were saying, Søren, CVC, you should do more technology. More recently, they have come and told us, it's really great you're not doing so much technology because that has had a bit of a crash. So, and we never promised to do technology, and that's what they reward us for now.
It's interesting that you mention it, Søren, because we are looking, one of the key analysis we are running at Moonfare is exactly where's the value coming from. And the top quartile funds, they are all overweighted, so to say, in EBITDA growth as a key driver. And if you want to say so, multiple expansion and to some extent leverage, which is the third value driver, that's better. Yeah, it's better. The alpha is really in the EBITDA growth. Look, let me talk or stay for 1 second in terms of what's happening in the fundraising world, because your fund, CVC, stands for a phenomenon that we have been seeing now for quite a while in private markets, which is that the large funds, the buyout funds, become bigger and bigger. And there's an interesting, behavior. Large institutional investors, in particular, in a more stressful fundraising environment, are pursuing, which is they tend to go even more so to the large players. What advantages would you say, and why is it? Because there are some data also speaking for small cap, mid cap, emerging managers. What is the advantage of that a mega fund brings to bear compared to smaller mid cap, small cap, or emerging managers?
So I'm clearly biased being at CVC, but I think it's pretty straightforward. We can diversify much more in terms of what sectors we are investing into, what countries we are investing into, what size of businesses we are investing into, what type of currencies we take exposure to. At CVC, we are focused on our portfolio is quite diversified. We are typically seeking to have like 30 to 40 companies in our portfolio. And because the fund is very big, because it's a mega fund, all those companies are of size and are robust. But we have fairly low concentration, so we are seeking to stay with like 5, 6, maybe 7% of the fund in any single name. Other firms, they don't have the luxury for that, so they end up with 10 or 12 or 14 companies in their portfolio, and therefore they are much more exposed to their largest investments. So some of them are doing 10 or 15 or even 20% in a single name. So if that single name goes well, they will be doing really well for the fund. If it goes bad, they will struggle to be a top quartile fund. Whereas we as CVC, we have very low loss ratio. Our loss ratio is around 1% in the past 15 years. Or we have a very strong corridor between 2 and 3.5 times multiple on money, where most of our investment comes out. And then we need 4, 5, 6 investments that are, say, home runs, like the 5, the 6, the 7, or even more times multiple on money to be a top quartile fund. But because we have that size as a mega fund, and we can buy these fairly big companies that are robust, where the risk reward is attractive, and then sometimes we're lucky, sometimes we're smart to capture that outsized return where we really make a home run. So I think that's part of the secret sauce. And then also, as a mega fund, at CVC, we have 54 deal makers. 54. Our bench is wider than anyone else that we're competing with. We have very strong deal captains in all the markets, all the sectors we operate in. If you're a small fund, you may have 3, 4, or 5 deal makers. And you cannot afford to have this like breadth of talent. And that makes a huge difference. So I would say the way you build the portfolio, the people the quality of the people you can afford being a big fund, and reward them to sustain them and keep them is absolutely critical.
Look, the industry is without a doubt in a slowdown environment. Though having said this, I attended IPAM in Paris and talked to some folks in the US in particular, and it seems that mood is changing again more to the positive. On the back of the ARM IPO and then other IPO announcements, seems that markets open up a bit more, but no one knows. In your view, let me ask you, what does the private equity industry need to stay ahead and continue to drive and show this overperformance?
So I'm not too concerned about the current slowdown in the market. And then there's like a bit of a gap between buyers and sellers on valuation. And we need to see views normalizing a bit and some of the risk maybe coming out of the market. So I think you will see a pickup when we get into 2024. We're also hearing from the banks that the flow of mandates coming to them at the moment is picking up strongly. So I'm not too concerned about that. I think fundamentally, I think the private equity model is superior to ownership model, is superior to many other ownership models. The alignment of interest with management, the drive from the board level to create value is fundamentally much better than in any other ownership models. And we don't need to be short-termish. We could be long-termish, long-term oriented in our value creation. So I think compared to when I joined, not a lot has changed. It's still a superior ownership model, and it will continue to be so for years to come.
Look, it's I couldn't agree more. Yeah, there is, by the way, tons of literature out there from Harvard, from Yale, on the superiority of the governance model in private equity and why is it solves the principal agent issue. And I remember, back in my times at KKR, and you said it, I've been in weekly contact with my CEO, and not like quarterly board meetings where and the decision maker sits in the board and it is much quicker. So many reasons, couldn't agree more. Look, we talked about the value levers in private equity, and currently in light of the high interest rate environment, leverage is probably the least relevant. But the current environment also gives managers, who have the experience and operational resources, basically to a challenge to drive and a possibility to make their portfolio companies even better. We talked about alpha generation, but it would be great if you could share with the audience a little bit what CVC's playbook is when it comes to operational value creation.
Yeah. So I think we don't have one playbook. We have multiple different playbooks, and among the senior deal captains, they have slightly different playbooks between them. But if I talk about a little bit about what we have done, for instance, in the Nordics, we try to find very good businesses that we can make great businesses. And I know a lot of people are saying that, but what we are focused on, and I could take an example. We invested a long time ago in 2012 into a Nordic business called Alcel. At the time when we bought it, we were making around 1 billion SEK of profit, and currently we still own it. We're making 6 billion SEK of profit, and we have taken margins from 6% towards 11%. And how have we done that? We have done that by basically working the full value chain of the business. We've been focusing on the sales side, on sales excellence, finding new customers, getting bigger share of wallet. We are very focused on procurement. Procurement is something I always do with all portfolio companies I invest into and are working with. So how do you get a professional procurement function going? I think it's a hugely neglected area for many companies. They tend to focus mostly on the top line, not on the big chunk where they could improve the cost. We are working with net working capital. We are investing behind the business. We doubled the warehouse capacity already once. At the moment, we're building out and doubling all our warehouse capacities in Sweden, in Finland, and Norway, and we've just completed it in Denmark. So it's some huge investments to give it ability to scale and double again. So there's not one little trick. That would be maybe, I'm not sure it would be easy, be nice, but there's a lot of things you need to do, and you need to back your management, support your management, be in dialogue with your management, and have alignment with your management. I think that's where we again differentiate ourselves a little bit. Our deal teams are 100% aligned with the management teams. We're almost like we're in the MIP program. We want to drive the performance of those investments, and if we do really well with the investment, our investment officers will do really well for themselves. And that's a bit of a difference compared to many other funds.
Thanks a lot, Søren. Very, very insightful. Look, you're very long in the industry, and I remember some 10, 12, 13 years maybe ago, the topic of sustainability came more and more up in private equity. And what I personally find a very important development is that sustainability really is not anymore, call it a buzzword, is really something the private equity industry takes very, very seriously. You know, when some of, the younger talents ask me who are interested in private equity, what would you do in terms of career planning? I keep on saying, believe me, in 10 years' time, there will be no fund out there who is not really taking sustainability extremely seriously, who will get any funding. And I know that you take it very seriously at CVC. Can you share us a little bit about your sustainable investing philosophy?
Yeah. So I'm a little bit lucky here because in the Nordics, ESG has been a theme for the past 15, 20 years. So we were probably a little bit ahead of the rest of Europe. But at CVC, we decided quite a few years ago, I would say 6, 7, 8 years ago, that we will have a huge focus on ESG. It's now mandatory for our portfolio to have an ESG rating, and we're monitoring to see how that rating improves over time. We also committed to SBTi, so our portfolio will have climate plans. So we are improving our climate footprints and reducing our CO2 footprint throughout the portfolio. And I would say it is as simple as the following. If you don't do it, you lose out. You lose out in many ways. You lose out in talent in the business. You lose out among all the stakeholders of the business, whether it's customers, suppliers, labor unions, political system, etc. You just have to do it. And it is the right thing. And what I find in particular interesting is that when we started to do it and we start to challenge the management team, and they said, yeah, we have now committed to SBTi, we need to be carbon neutral by 2050 at least, as often they say 2040, then I challenge them and say, listen, explain to me, this is your homework. Go back and find out what will it cost to be carbon neutral 5 years earlier, and come with the initiatives. Let me see the list of initiatives you could do, and what is the cost, what is the return profile, etc. And you know what? It actually turns out that a lot of the investments you can do are very attractive investments, where you get very nice payback very quickly. And it's to begin with, it's small things, and later it's bigger things. And as new technology is coming online, you can really make step change. But you need to do that journey. If you don't do it, your businesses and your investments will be worth much less at the time of exit. So at CVC, we embrace this. We embrace it in everything we do. In the portfolio companies, we embrace it and really push it. And we are starting to link the CEO's compensation to progress on climate, progress on ESG, into their bonus and their share option programs, etc. So it is a huge push we are going towards.
So let's talk a little bit about the deal-making environment. Roughly a year ago, 12 months, I would say, things really slowed down. The industry had a terrible Q4 2022. I think it was a 10% deal-making activity of the year before. 2023 has not been so much better. And many people, when we talk to senior executives in the private equity industry, they tell us, it has to do with a leveraged loan market, where banks cannot price really. Others tell us there's a very unrealistic gap in terms of price expectations. So sellers have not yet adapted to a new reality and are living in dreamland. What is it, in your view, what hinders currently, so to say, the engine really to start? What has to happen to come back to, let's say, at least a normal average deal-making activity in the private equity industry?
I say this is, of course, a bit uncomfortable to make predictions, but I think we're going to see a pickup in 24. And it's the reason I dare to say it is because the current activity level is so low, so it can almost only pick up. But I think we need to see this divergence between price expectations between buyer and seller to narrow, and we have seen that starting to narrow. We are starting to see the financing banks are coming back in the market, and like a year ago we said, do you think you could raise €1 billion euros or dollars? That can definitely be raised today. So we are starting to see improvements. We're also seeing the equity capital markets opening up again. And we have also been here now for a while, when often what's happening in the beginning of a crisis is a lot of people try to sell their, let's say, lower quality businesses. When you get it further into a slump, then some people will say, okay, but I have some fantastic businesses. There's nothing of quality out there. Let's try to monetize some of those businesses in full or in part. So you will see more quality businesses coming out that will attract more people. So I think like we are pretty patient capital. We are not in any rush to invest. So I think you will see this dynamic starting to play out, where better quality buyers and sellers are settling. The banks will be prepared to underwrite because the interest rates is now stabilizing. So it is going to be a much more predictable market, which is good for deal activity.
Let me ask you one question about a topic that is on top of my mind as an entrepreneur. The one, of course, can't compare Moonfare with CVC, but at a much smaller scale. We are now active in 23 countries around the globe. We have 8 offices. You are, of course, a globally leading large-scale manager, 25 offices around the globe. How do you make sure, and culture is everything, that you keep the machine, so to say, in sync, that all these people are aligned, working towards a common goal, that you maintain the CVC culture? As I call it, culture is the glue that holds everything together. How do you manage this?
So that's a good question. I think the way we operate as a firm, it doesn't really matter today if people are sitting in Italy, or they're sitting in Madrid, or they're sitting in Paris. We are in constant talk with them and dialogue with them. And we interact with them via video conference or phone calls or joint meetings, etc. And we have very low churn in our people. So a lot of people, like the average tenure for managing partner at CVC is 17 years. That's the average. Yeah. So we have lots of managing directors, senior managing directors, partners who have been with us for 5, 10, 15 years. So it is like if you want, a closely knit family. We know each other really well. We know how they think, we know how they operate. We have the same mindset when we are scanning for new businesses. And we stay in constant dialogue. We have like monthly deal pipeline calls. We have lots of different forums where we have discussions, and we work with our country teams and the sector teams. We work hand in hand on these new situations that we're. So even if you sit in a small office where you are 3 or 4 people, you don't feel like you are 3 or 4 people. You feel you're part of something much larger, and you will have your managing partners coming in for key meetings, or you will go for key meetings yourself. So it is really, yes, we may be local, but we are really global. And the way we work together and operate together is seamless. And then we have the magic glue of our deal carry, where you have an incentive to be, when you find something of interest, you put the best team together and you can create the reward closely linked to that from the deal carry. And that makes a huge difference.
Yeah, look, it's a very interesting one, and you know that, at least, you know, I have discussed the various carry schemes often quite controversially, and people, you know, some people in the industry say it's a eat what you kill model that you are pursuing, because the bulk, as I understand it, of the carry goes to the deal teams, and then there's a portion for the firm. But why are you, you know, and I think you are one of the more, call it, extreme examples when it comes to deal and firm carry. How do you make sure really that the firm then still is incentivized? Yeah, if I am a partner with a specific expertise in Belgium and there's a German or you deal in UK, how do you make sure that I have an incentive really to help out and bring the best knowledge to bear?
I think it's pretty simple. Listen, it's a tough world out there, and it's very hard to find a transaction and win the deal. So if you're the deal captain and you have found this new situation, you want to have the absolutely best people that you can attract around you, and you have the tool to do that from the deal carry. You can reward people to come in and help and work with you to win the deal. You can reward them for being engaged in the ownership period, the active ownership period, to deliver the value creation program and do the add-ons, acquisitions, et cetera, et cetera. So I think it's much easier than you in the real life to get this to work in a good way. And of course, we have some checks and balances around the system and some adjustments. So it's not like a lot of people, they ask us, so you must all be super risk takers. I say, why would we be that? Because if you have a good deal and a bad deal, you don't get just the good deal paid out, someone else pick up the bill after you. You net first and you only get the net result. So when people have done a really good deal, they are very nervous and they are looking at, what should I do a new deal because I put my equity at risk? And that's how it should be, because it's our investors' money. So we are very thoughtful and protective about our investors' money, and we do not take excessive risk, and we want to de-risk the investments for our investors, but also for ourselves as quickly as possible to protect that deal carry. So I think, if anything, it's sometimes we create people who are risk averse rather than risk takers, and that fits our culture quite well. That may not work in other companies where they are more risk takers, but in our culture and the way we are working, where we are cautious and I wouldn't say we are glass half empty all the time, but we are cautious in our approach. We are thoughtful in our approach. That carry model works very well in that culture.
So, and thanks for I find it, very, very kind and modest answer, because you could have said, look at our success. We just closed the largest buyout fund, and I know about your performance, which is stellar. So the system seems to work. Look, you talked about taking risks, and would be interested. There is in our business no free lunch. You have to take certain risks, deliberately. What has been your personal strategy in coping with failures? And once you had a failure, how did you come back on track, and how did you manage to overcome them?
So, yeah, that's a tough one, because like when you have been an investor for 25 years, there will be surprises that you could not foresee, and you put yourself under tremendous pressure when that's happening. My first investment actually didn't go well, and at that point in time I was on my own in the office in Copenhagen, and I was under tremendous stress. Like, the CEO called me, the CFO called me, the bank called me, my colleagues called me, and there was just not a way out of it. So I think it is important that you're strong as an individual. You do not take irrational decisions, and you try to understand what went wrong in that process. Luckily, you have very strong colleagues around you. You have a lot of senior leaders around you that will help and work with you and try to support you in the best they can around such a given situation. But we have been, as CVC, say, lucky that our loss ratio, of course, it has been a boom period, but has been very low. We rarely lose capital, but it is something that is stressing people and something that we work with with our people and in the leadership within CVC. We are trying to see who are the people that are stressed because they have portfolio issues or trading issues, and we try to support them the best we can in order to help them get forward and come out on both feet.
Thanks so much, Søren. Very, very, very insightful and interesting for me to listen, and I guess the same feeds the audience. Look, let me conclude, because we have, I'm seeing here to my right, many questions coming up, with one last question that I'm always asking in these deal talks. And these deal talks really are meant to be to learn from the most successful deal makers in the private markets world. And this is a personal one. If you could go back in time and you would give your younger self at that point in time an advice, what would it be?
So I think I would really love to have been listening more to what people are telling you and really paying real attention to what you're hearing, not just like sometimes when you're interviewing a CEO or you're trying to understand and build a hypothesis around a given investment opportunity, really take proper time and really listen what people are trying to tell you to form your opinion and not jump to opinion. Be a bit more humble in your approach in that situation. You're not supposed to know everything when you are a young person looking to build a career within investing. So being humble in the way you're thinking about the investment. And then when you have done both listening and being humble, then you need to build the confidence to make the difficult decision and say, this is something I want or this is something I don't want for the following reason. But then you need the confidence in that final stretch of winning a deal. You cannot be weak in that situation. So listen more, be humble, but then at some point you need to switch. And that when you switch, you then need to have the confidence to take it all the way.
Thanks a ton. Very, very helpful. Søren, we have tons of questions from our audience, and I pick one which is on top of minds of many investors, in particular also individual investors. When you started and I started at KKR in 2004, the industry was a niche industry. Today, private equity, that stands for some 25% of global M&A volume. It became a massive industry, and it seems that in terms of growth, if you talk to institutional investors who the majority tells us we will even put more money to work, increase our allocations going forward into private equity, private markets. It seems there is no end in sight. Many of our investors, ask themselves, what does it mean for returns? This overflow of capital, private equity firms partially chasing the same deals, secondaries from one private equity player to the other. What is your personal or the firm's view on how returns will develop in our industry for, let's say, the next 10 years?
Yeah. So I think first of all, I've heard many people over the years saying the best years are behind us. I don't think that's the case. I think that the industry as a whole will continue to evolve strongly and will continue to build momentum. The question is, of course, then some people said, yeah, but when you get really big, you cannot create these outsized returns when you're investing into really big companies. I think that's a very flawed assumption and is not fact-based in any way or form. So I think fundamentally it comes down to whether your managers managing and making the investments, they know what they're doing. If you're a sector fund, you need to have deep expertise in the sector. If you're a generalist fund, you need to be able to source the right deals, and you need to be able to generate the value creation plan again and again. And this is not a static industry. We develop all the time. We are now moved from, we call it VCP 1.0. We went to VCP 2.0. We have now VCP 3.0. So it's a more sophisticated toolbox we are using to generate the returns. And I think there's a lot of smart people in the sector. They will continue to find ways to generate the alpha, generate the outsized returns, and they do that fundamentally by building better businesses. You can occasionally be lucky to buy a business and get the multiple expansion. That's a kind of a one-off, but fundamentally, if you are buying a business, making it better, it will become more valuable, and that will generate returns. So I think the returns will stay. I actually predicted 6 months ago the returns may even go up a little bit compared to a few years ago, because interest rates have gone up. So the premium over the risk-free interest rate and the cost of debt, it needs to go up to capture the reward that's required for the equity. Otherwise, people will allocate into credit. So I think it's going to be very, very interesting next 5 years, where a lot of good investments will be made and a lot of money will be made.
Thanks, Tom. Here's another interesting one I find, and something, by the way, we introduced at Moonfare very recently, that we take more of a macro view, because we are in a much more volatile environment. Not everything, is in Greenland. And the question here is referring to whether you differentiate currently between more resilient sectors like healthcare or food or something, as opposed to take something extreme, very cyclical, media and entertainment. Do you take a conscious approach in your investment selection process right now, incorporating macro trends?
Yes and no. So 5 years ago, around 2018, 2019, the managing partners sat around the table, and we felt we were like 10 years into this bull run, where everything had gone up. And we kind of knew, and history book tells us that cannot continue. And we thought, what are we going to do about it? And the way we were thinking about it is like, we're going to tweak a little bit the way we are building our portfolio. So we went, say, a bit out of consumer and retail, and we went more into say, healthcare, sports, consumer stable, away from consumer discretionary. So we reshaped the portfolio a little bit, and that has had quite a nice impact. And then we started to focus much more on the value creation plan, making sure we had a sound and robust value creation plan that we could underwrite and we could deliver on. And if we had that, we felt that then we can still, even if there's a bump in the road, we will even be able to make our plus 20% returns for those investments, even if we had to go through a downturn. And that has played out really well. So far, knock on wood. It is something that we are working with constantly. But I think in general, as CVC, we don't say, let's focus on the macro. But that's not to say we're going to plow into Ukraine. So there will be macro elements. A few years ago, we started investing into Greece. And I promise you, we spent more time analyzing macro in Greece than micro of the company. So we are looking at it, but it's not anything we do across the board and forming a view that Spain is better than Italy or France or Nordics or whatever. We are saying it's more about how Europe may look like and how US may look like, but it's an input to the equation. It's not the answer to the equation.
Søren, you mentioned earlier today that you are cautiously optimistic when it comes to 2024. Of course, without sharing any specifics, but what are you seeing in your deal pipeline currently for your mega fund? And of course, no names. Everybody would like to know them. But related to it, the question asks: have you done already any deals out of the new fund?
The new fund, no. So we are still investing Fund 8. The new fund we raised is not activated yet. So what we typically do is we raise the fund, we do a dry close, and then we invest the rest of the fund, but then we can do a seamless transition into the new fund. So We will activate the new fund sometimes next year. But at the moment, we are still investing the old fund 8. We have made a few investments this year. We did one with the Nordic team in Scan Global Logistics that we completed, I think it was in May this year. So you can still do deals in the market, but we are selective, cautious, as you would expect us to be. We are just not piling in just because we need to deploy anything. We will take the time it takes and invest the money as and when we find the best opportunities for the fund. I think we will see pretty much something very similar to what we have seen in Fund 8. So it's going to be around, we like healthcare deals if they have the right kind of pricing, but even within healthcare, you need to break it down and see there are certain segments we like. It's maybe more services and medtech rather than pharma. We will go into sports. We'll continue to look for sports deals. We will look at consumer staples. We will look at good, solid industries with robust businesses that we can come up with a plan for how to improve. And whether they're in one sector or the other, we will be, thoughtful and analytical around our decision to invest or not.
So, and unfortunately, we have reached already the end of our deal talk. Look, I would love to continue. There are so many more questions from the audience, but for now, let me really thank you so much for being with us, for the terrific insights that you shared from this unique private equity firm, CVC, and your personal experiences. It was very, very insightful. I really enjoyed it very much. I hope the audience shares this view. I'm very, very sure it does. Towards the audience, thank you so much for being with us, for the many, many, many questions and the great participation. Please stay healthy. And of course, I would very be delighted if you would join us for our next deal talk as well. Thank you so much for being with us.
Thank you very much, Steffen. It was a pleasure to be here.
Thanks, Søren.